Ladies and gentlemen, good morning and welcome to the Sudarshan Chemical Industries Limited Q4 FY23 earnings conference call hosted by Dolat Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Tejas Sonavne from Dolat Capital. Thank you, and over to you.
Thank you, Ryan. Good morning, everyone. On behalf of Dolat Capital, I would like to thank the management of Sudarshan Chemical Industries Limited for giving us the opportunity to host their Q4 FY23 earnings conference call. From the management team, we have with us today Mr. Rajesh Rathi, Managing Director, and Mr. Neelkanth Natu, Chief Financial Officer. Without further ado, I would like to hand over the call to the management for their opening remarks, post which we'll open the forum for a Q&A. Thank you, and over to you, sir.
Thank you, Ryan. Thank you, Dolat Secretary and Mr. Tejas, for hosting our earnings call. Good morning, ladies and gentlemen. Welcome to Sudarshan's Q4 FY23 earnings conference call. Our investor presentation has been uploaded on the stock exchanges for your ready reference. I would like to take you through the financial highlights for this quarter. On the overall basis, it has been a strong performance in the quarter 4 of the current financial year FY23, both on the sales and margin side, compared to the challenging quarters of Q2 and Q3 of this current financial year. On the quarterly performance, on a consolidated basis, for the quarter, total income from operations stood at rupees 691 crore as compared to rupees 627 crore for the same period last year, higher by 10% year-on-year. EBITDA for the quarter stood at rupees 85 crore compared to rupees 86 crore in Q4 FY22, and EBITDA margin stood at 12.3 compared to 13.7% over the same period last year. Profit after tax stood at rupees 33 crore as compared to rupees 45 crore for the same period last year. Sequentially, revenue has grown by 31% at rupees 691 crore compared to rupees 528 crore of Q3 FY23, and EBITDA has grown by 100+% to 85 crore compared to rupees 42 crore of Q3 FY23, with the improvement in EBITDA margin from 7.9% in Q3 to 12.3% in Q4 FY23. On a yearly basis, total income from operations on a consolidated basis stood at rupees 2,302 crore versus rupees 2,201 crore in FY22, a growth of around 5%. EBITDA for the period ending 31st March 23 is at rupees 211 crore compared to 275 crore last year, and EBITDA margin on a yearly basis is at 9.2% versus 12.5% over the same period last year. PAT is at rupees 45 crore compared to rupees 130 crore for the same period in the last year. Now going into the details of our pigment business. Q4 FY23 has been the strong quarter for us. For the Q4 FY23, the income from operations stood at rupees 594 crore compared to rupees 558 crore for the same period last year, growth of 6% year-on-year. On a sequential basis, revenue is higher by 23% compared to rupees 483 crore of sales revenue in Q3 FY23. India sales for the quarter is at rupees 301 crore compared to rupees 286 crore in the same period last year. On a sequential basis, India sales is higher by 20% compared to rupees 251 crore of Q3 FY23. Exports for the quarter were at rupees 293 crore compared to rupees 272 crore last year, higher by 8% year-on-year. On a sequential basis, revenue is higher by 26% compared to rupees 232 crore of the Q3 FY23. In both domestic and export markets, we have seen early sign of demand revival in both plastic and coating segments. The specialty pigment sales stood at rupees 412 crore as compared to 388 crore for the previous year same quarter, 6% higher year-on-year. On a sequential basis, the revenue grew by 21% compared to rupees 340 crore in Q3 of the current financial year. Non-specialty sales for the quarter stood at rupees 181 crore as compared to rupees 171 crore for the same period last year, while on a sequential basis, revenue grew by 27% compared to 143 crore in Q3 FY23. Gross margin for the pigment business for the quarter stood at 41.5% compared to 41% for the same period last year. Comparing with the sequential quarter, it shows improvement over Q3, which was at 40%. After experiencing the volatility in the raw material prices for first 3 quarters, we are seeing softening of the RM prices now in Q4 FY23 due to drop in basic cost drivers such as crude oil, benzene, toluene, etc. This should help us in stabilizing the gross margin levels. Apart from the raw material costs, we are seeing softening of the energy costs in Q4 and also reduction in the coal prices, which should benefit manufacturing costs in the coming quarters. Logistics costs are also coming off from the peak levels seen earlier, and we expect this trend to continue. EBITDA for the quarter stood at rupees 73 crore in Q4 FY23 as compared to rupees 76 crore for the previous year same quarter. EBITDA margin is at 12.3% compared to 13.7% over the same period last year. Sequentially, EBITDA has grown compared to rupees 38 crore in Q3 of the last year. EBITDA margin shows the improvement over sequential quarter, which reported at 7.8% in Q3 FY23. Given the difficult external environment, management has aggressively focused on the cost reduction initiatives throughout the year. Overall increase in the sales, softening of the RM, raw materials, other costs, aggressive push on the cost reduction has helped us in increasing the margin and EBITDA for the quarter under review. However, we will have to continue with the pricing decisions with the calibrated approach to balance on the volume growth. We have also worked extensively on the reduction of the working capital, especially on the inventory level, accounts receivable, releasing the free cash flow, which has helped us in reducing the working capital debt level. On the yearly performance, yearly basis, total income from operations stood at rupees 2,079 crore for the pigment business versus 2,020 crore in the same period last year, a growth of around 3%. EBITDA for the period ending 31st March 2023 is at 194 crore compared to rupees 269 crore last year, and the margin is at 9.3% versus 13.3% over the same period last year. Recent update on land monetization. The company has on 6th April 2023 executed deed of conveyance with Birla Estates Private Limited to sell company's freehold clear marketable title land and measuring 5.76 acres along with the structures thereon located at 162 Wellesley Road, Pune 01 for a total net consideration of 356 crore. The company has completed the sale transaction and company plans to strengthen the balance sheet from the proceeds arising out of this transaction. On the capex side, let me inform you the status of the capex project which will drive the company's future growth. I am happy to inform you that we have successfully commissioned all the capex projects in this financial year. With this, we have transformed our product portfolio with one of the widest and most comprehensive product range in the industry. For the new product lines, we are getting good response from the customers, and these products are at advanced stage of evaluation. Given the current global scenario, we expect a slow ramp up in the short term, but we remain confident in the midterm that this capex will accrue the expected benefit. So to summarize, there are many positive tailwinds from the external side, like consolidation of top players in the industry, supply disruption from the prominent players in the North America, emergence of India as a key global manufacturing industry, and softening of the raw material prices and energy costs, which will be positive for the company. At the same time, we are very well prepared internally with all the CapEx projects being commissioned, with wider range of product portfolio, cost-efficient operation, and capacity to quickly ramp up the sales. To summarize, the year has been challenging for pigment industry and us on sales as well as the margin front. We have seen these pressures in the first 3 quarters of the current financial year. Q4 FY23 shows strong revival and performance on overall business and financial parameters. We are confident in our growth journey and look forward to continuing the same and delivering the value to all our stakeholders. With this, now I open the floor for question and answer session. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Sanjesh Jain with ICICI Securities. Please go ahead.
Good morning, sir. Thanks for taking my question. I have a few questions. So first, on the China competition, we have been hearing from the other chemical company that China is getting aggressive. Their domestic consumption has slowed down, and that has led to a lot more aggressive Chinese operator for the export market. And now that the commodity is also softening, and demand even on the global side doesn't look very exciting. Considering all this situation, how should we expect FY24 for Sudarshan Chemical?
So I think China. If you compare the last year China's demand was at the lowest, right, due to the lockdowns, due to the various lockdowns, etc. And there was surplus production. So that trend, I think, has improved. But at the same time, you're right, we don't see that ramp up happening on that. The second thing which has happened is there has been anti-dumping duties posted in China for blue and green pigments from India. So both, I think, from a perspective of India supplying blue green pigments into China, that's become a concern for the entire industry. And China's surplus, whatever they have in terms of supplies, they've been kind of, I would say, supplying at very aggressive costs in Asia and other regions. So I feel, from a perspective of last year, the situation is slightly better, but the situation still remains concerning. And that's where we differentiate ourselves with some of our portfolio and the services which we offer to our end customers.
Fair enough. So considering that all the CapEx program are completed and commodity prices have also eased out, how should we see the revenue growth for FY24? Can we achieve a 20% growth considering that we had a very soft year in FY23? Do you see a challenge to that? And again, you did mention that you have seen revival in both coating and plastic segments. I think that gives a little bit of confidence. But purely from the sales perspective, is that 20% kind of a growth really achievable?
So I think, sir, from a external tailwind perspective, we have very good tailwinds. As Nakuji explained in the conference call, a lot of top players consolidating, a little bit internally focus, a lot of focus on India as a key hub. At the same time, we are also well prepared with our capexes and the product portfolio going. So we do expect. I do not know. I can't, given the several uncertainties in the market, I can't give you a figure saying that this is what it is. But we do feel that the worst is over, and we should be able to kind of move on from here in the right direction.
Fair enough, sir. Next on the margin perspective, first on the gross margin, second on the other expenses. Gross margin on a consolidated basis, we are at 42%, and pigment, you mentioned that we are at 41.5. Historically, we were at anywhere between 43 to 44%. So that 200 basis point improvement can be achieved with this softening in commodity. Is that a right understanding? Second, on the other expenses, there has been a drop in coal prices, freight costs, and everything. But from our other expenses perspective, it still shows a very high inflation of 25-26% for a revenue growth of 10%. Can you help us reconcile the other expenses?
Yeah, Sanjay. So Nilkant here. So on the gross margin perspective, yes, what we have seen is a gross margin at 43.5 in the year FY21 when there were normalized, the cost consideration. What we are now seeing in the current quarter, the gross margin of 41.5% compared to the earlier quarters, which were at around 40 or plus 40. We expect that the stabilization in the raw material cost and one is the softening and second is the stabilization in the raw material prices should help us, because earlier we have seen it has been not only the inflation but the timing. During the quarter also we used to get those disruption in the raw material prices. Given the stable outlook, I expect that this particular gross margin trend should continue. It also is the impact on, earlier we have seen in the couple of quarters, the demand pressure and the pricing pressure due to that, wherein the certain pass-throughs were difficult. With the current revival in the demand, we expect that this level should get stabilized and we should get some uptick in the coming quarter if the raw material prices remain at the same level. On the other expense side, while I agree with your observation on totality, this is the company has done, aggressive cost push in terms of the various levers. Couple of factors which has impacted during the year. One is on the forex exchange loss side, which is around 16 crore, which has been published in the note. This is due to our, the capex loan, and it is more structural, and we monitor it based on our XIRR basis, so we are aware of those, variability in the foreign exchange. Second factor also which has impacted during the quarter and overall during the year is our eco business has also shown a good growth, and the site expenses related to that has gone up during the quarter as well as corresponding year. And the third factor which has also impacted during this particular year is the rising coal cost. So while we saw the stabilization coming in the quarter 4, but the coal costs predominantly were higher in the first 3 quarters, so which has also impacted that variability in the other costs. While we have taken a lot of measures in controlling the other expenses, which are more of a discretionary. Second, the company has to reach out to the customer and key customer engagement and key account management. We have also started investing in what I can say as a good business expenditure, which is travel as well as the exhibition cost. So we have reached out and we have participated in a couple of exhibitions in the last and in the H2 of this financial year. So with this, the other expenses is on a slightly higher side, but these are more of a structural and which are from the long-term perspective.
For next year, this should significantly normalize, right?
Absolutely. Absolutely. So Sanjay, while there has been a focus on the cost reduction which helped us during this year, the focus remains constant. We would like to cut the unnecessary fat in the system in terms of the fixed cost, whether it is a fixed or variable. The manufacturing operation has become very cost efficient, and we will continue that trend. We will be prudent in that matter.
Fair enough. So my last set of questions is on the new product contribution. Now that we have commissioned the capex, what is the number of products we anticipate, and what is the contribution we expect in next 2 years from the new product in our overall revenue? And what is the capacity utilization as of FY4 for us? And what is the capex plan for FY24? These are my last questions. Thank you.
So I think from a capex perspective, we've completed our capex plan completely. We don't expect any capex excepting the regular maintenance capex or any minor capex coming up. But otherwise, the capex program is full on. As Nathuji explained in the note, I think all our products are put to use now, right? So several chemistries have been launched, whether it's the Wallet 23 new product, Yellow 138 we had introduced earlier, but various versions we've launched through this CICP complex pigments, CICPs we've launched, solventized we've launched. So all our product portfolio now is complete and we've launched this. We expect, we are already seeing a good attraction for these product line. In the short term, we expect a little slower ramp up given the economic slowdown, but we are very confident, in the 3-year, 4-year horizon, we should be able to meet our midterm horizon. We should be able to meet our capex targets or benefits.
And the capacity utilization?
So right now we've ramped up our capacities and we're ready to go. I think right now we're not publishing some competitive sensitive information, but we have enough headroom to grow, sir, with the capex program.
That's all my question, and thank you for answering all of them patiently, and best of luck for coming quarters.
Thank you. Our next question comes from Ankur Periwal with Axis Capital. Please go ahead.
Yeah, hi Ratiji. Congratulations for a good rebound and in the numbers this time. Continuing with the product side, you did mention launch of many products there. From a stability perspective, have we reached a stable state here, or there could be some sort of time taken for these products?
So we've launched these products, sir. Now it's the time to get the approvals and we ramp up sales on that, right? So from an internal perspective, we are all ready now. Now it's all getting approvals and pushing the products into the market. Was that your question, Ankurji?
Yeah. So from a technicality, teething trouble, typically initially it may take time for the product to stabilize. That part is done. It's only the product approval which is.
Yes, sir. Absolutely, sir. Absolutely. Right.
And how much time? And also, second question related to that, from a product positioning or the target market perspective, are large part of these products domestic market oriented or international, and how much time will it take, in both the geographies for the approval?
So it's a global product range, and we expect to realize the benefits between 3 to 4 years.
So Ankur, Nilkanji also, as Mr. Rathi mentioned, these are the niche products, and as we already mentioned earlier, these are into the specialty pigment side. So the market will be both in domestic as well as the export market. Slightly the tilt will be on the export side. As Mr. Rathi also explained, technically these products are proven. It is the customer approval we are in the process of getting that. Couple of them are on board. So it will help us in both the markets going forward.
Sure. Just on the product approval timelines. I understand different products may be different, but broadly a range, will be helpful.
So, sir, the approval time kind of varies between 3 months to 6 months, right? And so we started this process. What we are saying is, sir, the ramp up earlier expected would be slightly slower given the slowdown in the market. So from that perspective, especially some geographies like Europe, etc., we see a slightly lesser uptake than what we were expecting initially, but that should we should soon see a ramp up in the midterm side given the tailwinds which we have.
Sure. Yeah, that's perfectly fine. On the margin front, we have seen a good jump on a Q-on-Q basis as well. Just trying to understand the earlier delays in RM inflation or the pricing-led discounts that we were facing earlier. Both of them are largely through, and now there could be some benefits of RM deflation, let's say, starting next quarter?
Ankur, hi, Nilkant here. So I agree with you. So with softening of the RM prices and with the stable RM environment, given that we also have the good wherein our sales number were higher, the effect of this RM fresh purchasing or new pricing should come in, and which we are seeing in Q4 also. And if this trend continues, we expect that this will get stabilized and we should see the normalized gross margin going forward.
And this normalized will be the historical average of around 42-43% odd.
Yeah, if you really see historically, we were in the range of, if you see from FY19 to 22, we were in the range of, 41.5 to 43.5. I would like to have the number midway, maybe 42 and 42.5. So maybe a quarter, maybe 100 basis points further. But it will take time to go to that level. I'm right now expecting that current level of the gross margin to sustain for a quarter. As we move along with the new inventories coming in and all that, we should be at the midpoint level fully.
Sure, Naduji. And the last bit from my side, for the quarter specifically, if I look at the Concall and standalone, which is, the subsidiary revenue had seen a pretty sharp jump. So could you help us understand what exactly are these subsidiary revenues for? These are largely the marketing, entities that we have, and correspondingly the overheads are also slightly elevated here. So just a clarity on that.
Yeah. So I'm telling you, if you really see the performance on the segment side, so there has been the increase in the RECO business revenue from 44 crore to 96 crore on the consolidated basis, while our trading arms in USA, Mexico, and to some extent Europe also has helped us in revival of the demand there, and overall growth on the foreign subsidiaries has been also good in Q4. In terms of the other expenses which have been elevated, as I mentioned earlier, RECO being a site-oriented business into the capital goods industry, with the revenue getting doubled between Q3 and Q4, there has been some ramp-up in the cost there. And couple of things which we did in the Q4 on the exhibition and reaching out to the customer has slightly given me the elevated Q4 cost, but we see it should get normalized in the coming quarters.
Sure, Naduji. That's helpful. Thank you and all the best.
Thank you. Our next question comes from Amar Maurya with AlphaStreet Advisors. Please go ahead.
So thanks a lot for the opportunity. Couple of questions from my side. Firstly, sir, what will be the volume growth for us in this quarter?
Amar, can you, please, volume growth?
Volume growth. What would be the volume growth? Am I audible to you?
So Amar, hi, Nilkant here. So normally we have not published yet the volume data, but just to give you the direction number, the growth has been good in terms of the volume pickup compared to the Q3.
Achha, we have seen the volume pickup compared to the Q3. Okay.
Yes.
And this volume pickup was, sir, largely, let's say, from the coating segment or from your basically the plastic segment?
So, Amar, this volume pickup or volume growth we have seen in both the markets, domestic as well as export, and in both predominant segments which are plastic and coating, both. Okay. With the plastic segment, what we had earlier also said in the couple of quarters, Q1, Q2, wherein we have seen that there was a lot of raw material variability in the plastic segment, which was on polymer side. It was the variability in the prices, and second was the availability. And with the scenario wherein the raw material prices were very much elevated, the master batch manufacturers used to hold their buying decisions, which we had seen in the earlier quarters. Now, with the stabilization in the raw material prices and with the stable outlook, we have seen the pickup in the plastic segment, and we expect this to continue.
Okay. And sir, in the coating is largely linked to the automobile, or this is decorative coating, let's say in the export perspective?
It is in the both. Slightly the tilt is on a higher side as far as the decorative coating is concerned.
Both in global market also?
Yes, sir.
Okay. Perfect, sir. Thank you, sir.
Thanks, Anuj. Thanks.
Thank you. Our next question comes from Nitesh Dhoot with Prabhudas Lilladher. Please go ahead.
Hi. Thank you for this opportunity. So my first question is on the market share. So for a few years now, as per our presentation, our domestic market share has remained constant at around 35%. So why is it that we've not been able to gain market share despite the increased focus towards pigment business over the years? And will this increase, especially with the large capex that has been put on ground over the last couple of years?
So I think from a domestic market, what we are able to gain is more on the product specialty product side. There is fierce competition on some of the commodity products, where so though we lose on that side, we are able to gain on the specialty product side. And I think that we will continue our trend towards focusing on the specialty sides. We do see good tailwinds coming in with a lot of investment in the paint section, which in the paint manufacturing area, in which we would be, we are really focusing on, participating in that growth, on that growth.
Sure, so thanks. That's helpful. Another question is, whether there's a meaningful difference between the pigments which you sell in the domestic market and that in exports, in terms of end applications and the pricing of the products.
So, sir, I mean, some of the product portfolio is even the Indian market is changing, where a lot of specialty products are getting used, but the percentage of usage in some of the some of the advanced economies, I would say, is more there, and that's how the product I would say the product mix changes. And certain product range, we do not take it globally, right? Some of the inorganic chrome pigments or the iron oxide pigments, etc., we do not sell these globally. We sell only in India.
All right. That's helpful. So thank you so much, and all the best.
Thank you. Our next question comes from Gagan Dixit with Elara Capital. Please go ahead.
Yeah, thanks for taking my question, sir. Sir, I see the quarterly trend. So looks like your especially this revenue on the quarter basis includes almost 70 crore something. While I see similar growth in this export revenue also, this almost 60 crore plus. So can I safely assume that this mostly your specialty is growth is driven by the export market revival? That's more, or you say relatively as compared to domestic?
Hi, so Nitin here. If I see the domestic and export split, which is 51-49%, and as you mentioned, there has been a 60 crore growth in the export quarter-on-quarter. Similarly, we have seen 50 crore in the Q3 to Q4 for the domestic. The specialty and non-specialty deals remain between 69 and 31% as a basket. And we see this particular growth coming in from both the markets, which is domestic as well as export. As Mr. Rathi mentioned, a couple of inorganic products are not, being marketed in those export markets because of the regulation. We see slight tilt in the export market on the specialty side.
And sir, which are the export market you see more revival? Because I see in the presentation that you mentioned still the problems still going on in the Europe. This demand is flat, and also there's a China issues also. So if you can indicate that, overall, just on the quarter basis or why this, where the demand is more this ramping up as compared to others.
I think, sir, as a long-term trend, we see great potential in the Americas, even the South American market, which we are also focusing and driving our growth. There are several initiatives which should really help us in the midterm, including Europe. For example, Europe, we've onboarded BASF subsidiary BTC as a distributor, and it also talks about it's also a testimony of we being a reliable and high quality supplier that BASF BTC has taken us on board, and this will definitely help us strengthen our midterm perspectives in reaching out to small and medium customers, right? So each geography, I would say, has the area. It depends on how it plays out, right? So with Europe, probably demand revising, I think these two areas should help us. Americas, we are driving growth. So these are some of the areas which we are going. In Japan, the digital link market is, and Korea, digital link market is very favorable, which we are selling some of our products in the digital links, and we are ramping up our sales there.
Regarding the China competition in the export market, so typically this on the pricing front, typically is there any Chinese have the price advantage or they are at par with your product prices?
So it depends on the product range. There is definitely a product range where we are not able to compete, especially in some of the commodity areas, right? So those are the areas where we, with China, we are not able to compete. On the other specialty areas, if the presence of Chinese is less, but we are able to compete on those areas.
Okay. That's from my side. Thanks, sir.
Thank you. Our next question comes from Rohit Nagraj with Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good set of numbers. So first question is on the specialty and non-specialty mix. So currently you mentioned it's 59 to 41. Over the next 3 years, once we put the newer capex of 750 crores, will this mix change more towards specialty, say, 35-25, or what is your perspective? Thank you.
Hi, Rohit, Nilkant here. Thanks. With respect to the specialty and non-specialty tilt, which is at around 69 and 31% currently, with the capex program which is commissioned and major focus is on the specialty side, we expect this particular tilt will be on the specialty side, wherein the specialty current percentage in terms of the revenue should move up from 69%. I would not like to put the number as such, but it should be around, on a higher side compared to what we have seen now with respect to the specialty. So upward direction will be there. Second thing is also between India and domestic, what we have seen 51 and 49, which is fairly a balanced mix. With this capex being commissioned, the tilt also should slightly move on the export side going forward.
Right. This is helpful. And second question is particularly on the balance sheet side. So we have seen a very strong improvement in working capital to 74 days from 96 days. So earlier probably the range was closer to 90 to 100 days. Is this 75 days of working capital sustainable going forward? And second question is, given that we have received the money from land sale, what is the kind of debt reduction that we expect by FY24? Thank you.
Thanks, Rohit. So on the working capital side, as you have rightly mentioned, we are at now 74 days of the net working capital cycle. And as I mentioned in my opening remarks, the great work done by the team internally to reduce the inventories and also to make the operation lean and with the collection of the account receivable. If you really see our net working capital as a percentage to sale is at around 20%, and historically we used to operate between 24 to 25% earlier. And earlier we indicated as a management that we would like to go gradually to the 20% level, and we were targeting 22% as one of the midway to get into that particular aspiration level. But happy to share that we are at around 20% at the year end. While there may be certain variability in this particular percentage during the year based on the raw material supplies, availabilities, maybe some strategic call, we expect and we will work towards maintaining this level plus minus 1%. That is something I can look at. And that has also helped during this particular year for the debt number. Despite the EBITDA being down by 70-80 crore, our debt number are flat, which is at 794-796 crore in terms of the net debt. Regarding your second question on the land monetization, so yes, this land monetization will help us in improving our balance sheet. Currently, we are at around 794 crore of the number. If I see the net debt, if I consider this 300 plus crore of land monetization, we are at closer to 500 crore. So we as a management have taken a call to reduce the debt over a period, and we should be more leaner in the next year as far as the debt numbers are concerned.
Yeah, just one clarification. During FY23, were there any one-time consultancy charges for the projects which were undertaken and which will not be recurring in FY24?
Come again, Rohit. Which are
any consultancy charges that we had paid for any third-party consultant? I think we were working on the margin improvement projects with some of the external consultants. So is there any one-time expense for those consulting charges during FY23 and which may not recur incrementally?
Yeah. So Rohit, we did not have any one-time or complete charges on the margin improvement, etc. in the current financial year FY23. So there was no one-time there.
Sure. Thank you so much for answering all the questions and best of luck, sir.
Thank you, Rohit.
Thank you. Our next question comes from Archit Joshi with B&K Securities. Please go ahead.
Good morning, sir, and thanks for the opportunity. Sir, I just one question. So the market leader has kind of indicated that there are a couple of areas where there's been an improvement, and the outlook in cosmetics and displays as a category within which pigments are used, that's showing some signs of revival. I just wanted to understand if we have any exposure to these industries where we can see some revival globally. Also, they've mentioned that some of the key categories like coatings, plastics, and printing inks are still reeling under a lot of pressure with respect to inventory adjustment. In our view, when do we see this reversing for us specifically, even if it's not for the industry? That's it, sir. Thank you.
So I think for us, yes, cosmetic and displays are the jewels are an important segment for our growth too. However, if you look at the market size compared to the entire market size, two market size are quite small compared to as a percentage to the total market, and so though we'll be going there, whether they have a significant impact on our overall perspective is the question, but these are very important segments, strategic segments for us to grow. With this, sir, I think there are, so it's a comparative area, and we have seen some improvements compared to last year on the demand side from the three traditional industrial sectors which you spoke about. And So we do believe that the worst in demand things are over, and there is a gradual improvement which is coming up.
Understood, sir. So while you say that the displays or the cosmetics, these categories are pretty small in the overall scheme of things, can you throw some light on this displays business or the displays industry? Where exactly are these pigments used? I mean, from the application perspective, is it more towards electronics in laptops or with smartphones growing quite significantly? Would this be a growing area going ahead? If you can share some of your insights on this segment. Thank you.
So digital inks is an important. This comes under digital inks, and under digital inks, there are two segments. One is the inkjet, the toners, and displays, widespread displays. So overall perspective, these are the areas where these products go. We think it's a strategic area, which is a good growth area. Though the entire volume is the margins will also be better, and that's how we had embarked on this. All our development work in this area was completed between our R&D in India and Germany lab, and our product range is completely ready, and these are the products which we are really selling into Japan and Korea now, and we have several approvals in this area.
Got it, sir. Thank you. Thanks, and all the best.
Thank you. Our next question comes from Arthur with ICICI Prudential Mutual Fund. Please go ahead.
The opportunity. So just two questions. One, what would be our capex number for next year in terms of range, ballpark range? If you
So Arthur, Nilkant here. So as we mentioned, the majority of the capex program is over, and this year will be the stabilization phase for us. So we will only continue with the sustenance and the maintenance capex. Would not like to put the number, but it will not be the most significant.
Our engineering business, which was a small portion, has been ramping up well. So any evaluation to eventually sell it, or any thoughts on that? How should one think, given it's non-core?
So Arthur, yes, so there has been a revival in the RECO business. The board is also looking at this revival, and this year has earmarked in terms of the turnaround compared to the last year. So board will take at opportune time the decision regarding that. As of now, there is no discussion in terms of the. Hello. Yeah. Okay. Yeah.
Arthur, do you have any questions for the management?
No, I'm done. Thanks.
Thank you. Our next question comes from Madhav Marda with FIL. Please go ahead.
Hi, good morning. Thank you so much for your time once again. The sense I'm getting is you all are sounding much more confident on ramping up the new capacities versus earlier, and probably seems like there could be some decent market share gain opportunities, which has been the thought process in Europe, South America, and North America. Is that the right understanding I'm having, that finally all this consolidation which is happening in the pigment industry and our new capex coming in, product portfolio expanding, now all of those things are coming together, and now we should see steady growth? Of course, macros is something not in our control, but what's in our control seems like things are falling into place. Is that the right sense I'm getting?
I think Mauzi well summarized. Like you said, so we were always very confident about our capex program, right? That was the area of transformation for the company in order for its growth and good sustainable growth, right? So given that we had so many headwinds in the last 2 years when we began the capex program, we did face it very well, I think, and we have now kind of completed the whole capex program. we do feel that the ramp up will be there. The the initial part may be a little tougher because of the slowdown, but I think given that there has been no dearth of attracting the customer for the product line. So there's a lot of pull there, right? How we ramp up is the real question. The short term is a little bit of a concern, but I think overall, in the overall midterm period, we are very confident that we should meet our capex benefit targets.
Understood. Yeah. And then the second question was, seems like our gross margins, like Mr. Nilekar said, that one quarter more maybe, and then we should see some bit more of an uptake on the gross margin side. And even on the fixed cost side, there has been obviously like high freight cost, on the other expenses, and then high coal prices. So all these things, and we've always, like, if I look before COVID, we used to be the 14-15% EBITDA margin range. So do you think we can get back there towards the end of FY24 as we approach like Q3, Q4? Of course, given like macros remaining and inflation remaining where it is. On a steady state basis, our margins can see some more uptick from gross margins and little bit more on the other cost side?
Madhav, yes, with the gross margin stabilization currently at 41.5%, with the raw material stabilization and the stable outlook, I expect that this trend should continue and should sustain. And if it continues, then definitely it will reflect in terms of the EBITDA. While we have historically achieved the number of 15% in FY21, given the market scenarios then, I would not like to put the number as of now for what is the EBITDA for the next year. But directionally, with this stabilization coming in and overall the confidence of volume bounce back, I expect it should help us in improving the EBITDA percentage in couple of quarters.
Got it. And just last question, the land proceeds have already come in, right? Like we've already received the money from the land sale?
Yes, Madhav, we have received the money. It's this financial year. In April.
So Q1 onwards, yeah. Good. Okay. Yeah, perfect. Thank you so much for your time. Thank you.
Thanks, Madhav.
Thank you. Our next question comes from Chetan Thakur with Ask Investment Managers Limited. Please go ahead.
Good afternoon, sir. Hello.
Hi, good afternoon, Chetan. Hi.
Hi. So just wanted to understand more from a medium-term point of view. So we've historically seen your gross profit margin in the range of 41 to 43. Given that the products that we've launched and we filled the basket in, would it be a fair understanding that over a medium term we can add a couple of basis points to this range as those products increase in terms of contribution? And that plus the efficiencies will eventually drive the OPM over a more medium term.
Chetan, yes, Milton here. So directionally, yes. Given the current the range of what we have seen earlier, 41 to 43%, more stabilized range of 42%, where the specialty and non-specialty tilt was around 69-30. With the ramp up and the new product capex, which are more in the high performance segment specialty side, directionally in the coming year, this should give us a better benefit in terms of the gross margin.
And the capacities that we set up, fair to assume in 3 years if things go normally, which we've not seen sometime, but still assuming it goes, most of these capacities would then be utilized. That would be a fair understanding.
Absolutely. So given the current scenario, we are expecting that this ramp up will be during 3 to 4 years period of time. Absolutely.
Sure, sir. Thank you so much and all the very best. Thanks a lot.
Thank you. Our next question comes from Janam Gilani with Swan Investments. Please go ahead.
Hi, sir. Thanks a lot for this opportunity. So I missed the initial part. So could you tell me what was the amount we received in the land deal?
Hi, Janam. Welcome here. So we have received 356 crore in terms of our land monetization.
And so assuming we achieve peak utilization in 3 to 4 years, what can be our current revenue, like that revenue that can, the peak revenue that can be reached in 3 to 4 years with our current capacity? Hello.
Hi, Jana. So assuming the capacity ramp up from the new product CapEx and, the full utilization, we expect that the revenue with the current normalized pricing scenario should be in the range of around 3,000 to 3,300 crores going forward in the next 3 to 4 years period of time.
Okay, sir. Thank you. That's it from my side. Thank you, sir. Congratulations for a good set of numbers.
Thank you, Jana.
Thank you. Our next question comes from Jay Ketan Shah with Capital PMS. Please go ahead.
Hello.
Hi,
Can you
Jay.
hear me? Hi. Congratulations for a good set of numbers. A couple of questions, majorly on the specialty side. When you say that you are trying to increase the mix to specialty products and already have started the work, what is the approach of the company? Is it more like we choose a sector or a client and then we look at creating entry barriers using chemistry, or is it more of a pull from the client saying that this is the kind of applications they are looking at, and then you become a helping hand to them? So I just wanted to understand, one is that question, and second, like you said.
Jay, sorry to disturb you. There was some disturbance. Can you please repeat the question?
Sure. Can you hear now? Is it clear?
I can hear you.
Perfect. So when you say that the mix between specialty and the not so specialty is going to be leaning more towards specialty, what is the approach of the company? Is it more that you first choose a typical chemistry and try to create entry barriers for the peers, or is it more like the client asks you to make something which is technically challenging in a way, you can say, in terms of chemistry, which kind of gives you a moat, if so say so? Like, what is the approach when you say specialty of the company?
Right. So I think it's a good question, sir. I think when we 3 years ago, we embarked on looking at our whole global strategy and how, what's going to differentiate us in the market. The answer came out very clearly that we have several capabilities which we can exploit in, and one area was in the differentiated product range. Because the commodity product range was already very crowded, and we could see the writing on the walls that the margins in that area is going to reduce, and this is where we are seeing a lot of bloodbath if you look at the cyanine or other pigments. So that was the overall strategy to kind of travel the difficult path in creating this product portfolio. And I'm very glad to say that right from scratch to developing the chemistry, to pilot trials, to commercializing this on the plant, putting up the whole plants, this, our internal team has been able to do this. And it's a wide variety of chemistries, right? When we talk about all the product range we are saying, it's not like, in the pigment industry, you have one product which is going to give you like a bullet of 1,000 crores or something, right? It's a very, very broad portfolio where you have to look at. So from that's been our strategy. Then, of course, once this was clear in our strategy, then we started engaging with customers on what was their pathway. Obviously at each stage, lab samples were exchanged, detailed discussions were happening, and we are now right now on the stage where this has got fructified into real products, where we are engaging with customers now to for these products.
Okay, got it. And secondly, I wanted to ask, you said that there is a lot of movement happening in the paint manufacturing sector. So are you guys looking to even tap into the pigment dispersion chemistry, like someone like what Decol Organics or Saujanya or Clariant are doing? So are we even looking as that as an ancillary stream of revenue, or we focus on pigment itself?
So pigment dispersion is an important strategy, but we would never compete with our customers, right? And that's how we had exited our master batch business also, where we said we want, one of our values is going to be, and it's a close partnership. I mean, how one of the pillars of our differentiation is customer intimacy and building that trust. So we would never compete, in fact, with our customers. You mentioned about Sardinia, a very dear customer to us, and we would never think of competing. But what we do is, on the pigment dispersion side, we, coating companies are always making a make or buy decision, and from that perspective, we are, so that's where we work with the customer to make those product pigment dispersions for them. So that's one segment for coatings for pigment dispersion, but there are specialty applications, where pigment dispersions also go in, and we are again ramping up our product range to reach out there. We've already done that actually.
Okay. Thank you so much for your time and all the best for the future quarters.
Thank you. Thank you, Jay.
Thank you. Ladies and gentlemen, we have reached the end of the question and answer session. I would now like to hand the conference over to Mr. Nilkant Natu for closing comments.
Thank you, Ryan. Thank you, Tejas, and thank you, participants, for your time and interest in Sudarshan Chemical. We remain confident in the long-term prospects of our business, and we look forward to engaging with you again in future. Thank you.
Thank you. On behalf of Dolat Capital, that concludes this conference. Thank you for joining us. You may now disconnect your line.